Now the rate of return, let's say if you sold your bond earlier, you might make a loss by selling the bond, or you might make an additional gain, and that's separate from the yield to maturity. So we have this one here on top too. So the rate of return is important when you sell your bond earlier. And as we saw, bond prices can fluctuate depending on how the yield is changing in the market, and the yield changes every day, so you might make an additional gain or might make an additional loss. And then you have to calculate the rate of return. Trick question. If you for sure know that you will hold the bond till the end, for example, till the end of the class or for the 10 years until it's mature, does it matter what happens to the price in between? Let's say, for example, if you have a global financial crisis and bond prices crash in between, does that matter to you? No. If you surely intend to hold the bond till the very end, what's happening to the bond price in between doesn't matter. Except if, let's say, the issuer is getting into real problems that it's clear you won't repay your money. Just the random fluctuations in between doesn't matter. Because at the end of the class or at the end of the bond, how much money do you get back? Let's take this one here. How much money do you get back for sure at the end of the class? $10. As long as I'm around, we've got a contract, you get $10 back. But if you might want to sell the bond early on, then of course it matters, the price fluctuations, and then we need to use this one here. Good, let's do this one, 2 minutes to you. Please don't do any research. What kind of risks do you imagine you face with these 4 different bonds? Let's do 1-year Australian government bond versus 10-year Australian government bond. No ideas? Okay, let's try another one. Greek government bonds. Surely somebody can think of risks there. What might be the risky part of a Greek government bond? If you follow the news a little bit. They might not be able to repay or not willing to repay. Exactly right. And that's so-called default risk. So that the issuer simply runs away. That would be your risk too, right? If I run away from the class, don't repay you, default risk. With the Australian government bond, you would think we don't have any default risk. So in 1 year's time, 10 years' time, you would think the Australian government is still around. What might be another risk with Australian government bonds, though? They might offer a better bond tomorrow. Exactly. So the yields in the market might change. And if the yield in the market goes up to 10, 15%, ridiculously high numbers, what's happening to the value of the bond that is in your pocket? Down. So if you bought a bond now, and let's say at $99, and the yields go up, it might be worth only $98 in the future. Where would you be more annoyed if the yield is going up tomorrow? If you have a 1-year bond or a 10-year bond? 10-year. Because then you have to wait for 10 years till you get your money back and can invest it at the higher yield. And it's also hard to sell that 10-year bond, because if you sell it, the new buyer wants to get which yield? Your low 10% or the new 12%? 12%. So that means you have to sell it at such a low price that he's getting 12. And if you sell it at a low price, means you take the loss. So that's called interest rate risk. If the interest rates change, that's the interest rate risk, and that's worse on the 10-year bond. Then there is 1-year Carlos Slim Halo bonds. Number one risk might be he's going into default. Who knows Carlos Slim Halo? Anybody knows him in this class? Don't say anything yet. So one guy knows him. Imagine you have Carlos Slim Halo bonds. Anybody wants to buy the bonds off him? Let's say yesterday it was worth $100. There was something in the news today. Anybody who wants to offer $100 for that one? No, because what's the problem? If you don't know him, it's risky. Carlos Slim Halo is one of the richest people in the world, and he has no problem with default risk at all. So that bond would be perfectly fine. But if nobody knows it, it's still hard to sell. And that's liquidity risk. The market might not be there. Nobody might be in the market. Even though you've got a bond that is perfectly fine, but you need money now, you want to vacation, pay for a house, buy a new car, whatever, that would be a huge risk that you can't sell it.
Let's make a practical example for the 1 versus the 10-year Australian bond. Let's pretend the initial yield was 4.5% and use it in our Excel sheet. Check what will happen if you increase the yield to 5%. Also check how the two bonds might differ in their reaction.
We had one bond that's running for 1 year, one bond that is running for 10 years. Now if we change the interest rate, let's say if I change this interest rate to 5%, so the market yield goes up, then we know the bond price is going down. It's going down for this one, and it's also going down for that one. But here's the trick question: for which one is it going down more? If the interest rate in the bank goes up, when are you more upset? When you're having a 1-year bond or a 10-year bond? 10-year bond. So with the 10-year bond, you're more upset, hence the price will fall by more. So the longer the time to maturity, the more the bond price is reacting to interest rate changes. And long-term bonds, their prices change much more. That's called interest rate risk. So if the market interest rate change, your bond price is fluctuating. And you might make a profit or a loss if your bond portfolio becomes less valuable and you sell it at a loss. Good, so long-term bonds are clearly more volatile. If you hold the bond till the very end, well, then you don't worry about the price changes in between, because at the very end you always get back the face value that is printed on the bond. Good, now here we've got a different example. Here we've got two bonds, and now time to maturity on both of those bonds is 10 years. I've got a 10-year zero coupon bond, so there's no payments in between, and I've got a 10-year coupon bond with 10% coupons here. So I get 10 $100 coupons. So the time to maturity is the same, but what we will see now is that the reaction to interest rate changes is not going to be the same. And maybe think about the intuition already. Let's say it's 10% here. Now the interest rates in the market increase to 11%. Which bond do you rather have? The zero coupon bond or the coupon bond? Maybe step by step. What's happening to the bond price of the zero coupon bond? If the interest rates in the market go up, the value of that bond will go down. The coupon bond, if the interest rates go up, the value of the bond will go down. Both of them will go down. Question is, which one might react more? They both run for 10 years. So we can't say the answer from beforehand, the one with the longer time to maturity. Time to maturity is the same. But there's one difference. Here we get some money early on. How long do you have to wait till you can reinvest your money at 11% at the new interest rate if you had this bond? 10 years. How long do you have to wait till you can invest some money at 11% with a coupon bond? 1 year. After 1 year you get $100 already which you could reinvest at 11% now. So from that point of view, this coupon bond is better for you. And that's the reason why the time to maturity is not sufficient information when we look at the interest rate risk, how strong the price reacts. We need something else, and that something else is called the duration. Just to give you a quick number example here, what's happening. So these are the two bonds. 10% was the yield yesterday. So the price of the zero coupon bond is 385. The price of the coupon bond is 1,000. By the way, can everybody see why it's exactly 1,000? So the market interest rate is 10%, and the coupons are also 100, 100, 100. Right? So if the coupon relationship to the face value, the current yield, is the same as the yield to maturity, then the bond is selling at par value, face value. Now let's see what's happening. If we're increasing the yield in the market to 11%, we already know that the bond price will drop. Drops by $60, that is roughly 6% here. Now let's see what's happening with this one here. If you put in 11 here, let's see, 6% drop. I just round that up so I can calculate in my head. Let's say this is roughly 400. 6% of 400, 16. So if the drop would be similar, it would be a number similar to $16 drop. So that would make it roughly 370, roughly. Right? Let's see what's happening here. 350. So this is much bigger than a 6% drop. And the reason is because we have to wait so long here till we get some money back. Here we get some money back earlier, which we can reinvest at 11%. By the way, it of course works the other way around too. If the yield would be dropping, the bond price would go up. So it used to be 1,000. So bond price goes up also by roughly 6%. Now here we also know if the yield is dropping, the bond price will go up. But now in this case, are you happy that you've got the 10-year bond with no repayments in between, or unhappy? If the market yield is going down and you have the zero coupon bond in your hand that had a yield of 10%, or unhappy? Happy, because your neighbor that has this bond, after 1 year, he has to reinvest his $100 at 9%. You don't have to worry, all your money was locked in at 10%. So here in the upwards direction also much bigger change. So the time to maturity is the same, but there's a certain measure that's called duration. And duration is like the average time we have to wait for the money.
So we learned that the yield to maturity is forward-looking and is the actual interest rate that we're earning if we hold the bond to maturity. However, if we do sell the bond earlier, we have to look at the rate of return because bond prices can change over time. And it's not guaranteed that we can earn the face value if we sell premature. There are numerous risks. We focus on default risk, that means we might not get repaid. Interest rate risk, which is the most important risk for this class. There's also something called reinvestment risk, which we will skip by and large for this class, and liquidity risk, which we will discuss much later. The next set will be durations, which is going to be a super important topic.